Hi, welcome to the channel. Shateka Husser here, coming to you. Just want to tell you really quickly about how to determine how much death benefit you actually will need. If you don't know who I am already, I'm Shateka Husser, and I help you retire before you expire. So if that's what you desire and what you aspire, we are the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. And I know so many people hear me say that often, but that is really what we're about. And sometimes it takes people 7 times to hear something to get it. So hopefully you've heard it at least 7 times by now. So you get it. Either way, I want to tell you how to determine how much death benefit you actually are going to need for your beneficiary, right? So what we normally do is spell out the word dime. It's really simple. DIME, D standing for debt. How much debt do you owe? Okay, rather that's student loans, that's taxes, that's whatever you have some type of balance on, your car, so many other things. And that's what it stands for. The I stands for income. All right. So 3 to 5 years of income, rather it's 3 to 5 years of income or 5 years of income or 7 years of income, 10. It really is up to you. But the average person is going to leave anywhere between 3 and 5 years. And then, of course, the M stands for mortgage. Do you have a mortgage that's left, right? How much mortgage do you have to pay off? That is the M. The E stands for education. Do you have any children? If so, about $100,000 per child. In other words, $25,000 per year for 4 years per child. All right. So that's pretty much very simple, very quick, how you determine how much death benefit you have. Now, a lot of people penny pinch on the death benefit when they do a permanent policy because it's more expensive. Did you know that you can actually blend your policy to where some of it can be whole, some of it can be term? Well, let's just say like this: some of it can be permanent and some of it can be term. Like, for example, if you had an index universal life, some of it could be permanent and some of it can be term. Or you can just do all of it term. Some people don't like term because there's no cash value buildup. But what if there is a way you can get term where you can get the best of both worlds? You can still get your living benefits. In other words, if you have a heart attack, cancer, stroke, or dementia, you can still add that in there. And you get 100% guaranteed refund after 25 or 30 years, whichever one you choose. Or you could have a paid up policy if you decide you don't want 100% of your money back. For example, let's say you got a term policy and it was $300,000. Well, after 30 years of paying on it, it's about $100,000 that you paid into it. We're just throwing some numbers out there. You would get $100,000 back, or you could have a paid up policy for about, say, $60,000 to $70,000. Okay. So understand that those options are out there. And if your term policy is not doing that for you, then you definitely are missing out. I like to say that who has time to donate money to a carrier? Nobody has that kind of money, right? So the goal is to try to get all your money back, or at least have some type of paid up policy. Or you could convert it to, a permanent policy. Rather it be whole life or an IUL. You can convert your term policy up into a whole life or an index universal life, depending on the carrier and what products that they offer. So main reason why we wanted to come on here is because you wanted to make sure that you have enough coverage. So go back, look at all your debt, look at how much income you would want to leave for your spouse or your children to grieve. It really is about how many years of grieving do you think they'll need of income, right? And so some people like to leave 3, 5, 20 years. This depends on the individual and their budget, and then of course, if there's a mortgage, I like to call this the best mortgage protection. Because did you know that mortgage protection that most people know of is not really mortgage protection that benefits the consumer, but it actually benefits the lender. So if you default on your loan, the lender is the one that's going to be able to, make out, and you won't. Unfortunately, your family won't. Unfortunately, you still won't have a home if something was to happen to you, right? So the goal is to be able to have wealth creation, and if you could have that death benefit pay off your home, and they have a home to live in, because would you want your family to be displaced because you thought that you had mortgage protection and when you really did not? You only had something that protected the lender from, you defaulting on the loan. That's the kind of mortgage protection that you actually have. I think that more people need to understand that, right? Some people do, but you'd be surprised by the amount of people that really don't understand that. And then, another way that you can increase your death benefit is to add on accidental death benefit. It's really simple. It's very inexpensive. Most banks offer it. You might have AAA, different places that offer the accidental death. The only issue with the accidental death benefit you need to understand is that you have to pass away in an accident in order for it to pay out. And of course, it is going to double in most cases. It's going to double whatever your face amount is. So it's very good in that regard. But if you die from natural causes, unfortunately, it will not pay out. So yes, it gives you a lot more coverage, but you would have to, pass away in, a major an accident, such as, an aircraft or a vehicle, helicopter, things of that nature. So just understand that that's how that works. And of course, sometimes on term policies, you can or cannot add children riders. There's all types of riders that you can add to those policies. But the goal is to understand that if you want to have your children covered, the better policy type would be whole life, only because you get it at the cheapest rate. Think about it. If your parent, if you don't already have a policy on yourself, what if your parents place a policy on you when you were 15 days old, like the wealthy do, their children? How great would that have been, right? Because it would be super cheap. So the best policy for children really is their own children whole life policy, or children index universal life, this depending on what you're trying to accomplish with the policy in this end state. And we'll determine which one. But a permanent policy is way less expensive when they're a child than when they're an adult trying to put it on themselves. Say when they're 18, 20, and they have to go and take out a policy on themselves. Down is more expensive. So you can give them a break by paying only anywhere from $20 to maybe $50 a month, so that they can have their own policy on them. And I know quite a few people that are doing that and setting their children up for success. And so why not you if you haven't already? But the goal is that the parent would already have to have some type of policy on themselves before they can actually put it on the child. That's the way that works. But if you have any questions, any concerns, have any feedback, we welcome it all. Let us know. Our goal really is to help individuals to understand these different tools that are out here to help you to build wealth and to make sure that you're properly covered. We don't want you underinsured. If anything, we want you overinsured. But the best insurance is insurance that's in place when you need it, when your family needs it. All right. God bless you. Have an incredible day. And I will see you at the top.